Shares of Under Armour down more than 9% as the company holds its annual investor day. So, Sarah, you covered the stock. It had been a little bit on the comeback trail, had been trading about a week ago at its highs for the year, but now kind of falling apart. What
it was
happened?
A hot stock this year going into today, at more than 50%, but big disappointment. This was the first investor day in 3 years for Under Armour, and investors not so far liking what they hear. The company offering an outlook for the next 5 years. So what we know now, and there's news flowing out on this all hour long, revenue is expected to return to a low double-digit growth rate by 2023, driven by international growth and their direct-to-consumer business. The company is also projecting low single-digit growth annually in North America over the next 5 years. It's an area where the company has struggled recently. Meanwhile, Under Armour sees revenue growth in Europe, the Middle East, Africa in the mid-teens during that span, the high single digits in 2023. Those are just some of the highlights here. And they're a little bit underwhelming, especially because investors and analysts were very optimistic going into today on the return to growth in North America, better growth. It's not the 20% days like we saw with Under Armour in the beginning. Still, even with the big drop, the stock is up more than 30% so far this year. But if you go back when it peaked in September 2015, it's down sharply from that level. And CEO Kevin Plank did talk about that today, saying the company lost focus after years of very fast growth. But right now, he says they're in the middle of a turnaround, and he's optimistic. Listen.
We're roughly 2 years through what we've defined as a 3-year transformation for our business. And over the past 2 years, we've been successfully executing against a strategic, operational, and cultural transformation to become smarter, faster, and stronger.
Also just wanted to mention, with trade tensions running high with China, Under Armour is saying that they're moving away from sourcing products in China. The company says the plan is to source just 7% of total products from China by 2023, which would represent a pretty big change. It has almost 20% right now, and even that has come down dramatically over the last few years. So clearly, that's a risk, but we know that was out there. It's those longer-term forecasts, and yes, the company is projecting higher margins and better profitability, and that's thanks to the addition of COO Patrick Frisk. By the way, tomorrow on Squawk on the Street, I'm going to be speaking with both of them, first on CNBC. Kevin Plank, Patrick Frisk, he's the COO and operator. Kevin Plank is obviously the founder and CEO. We'll talk about this stock move today.
Yeah, it's fascinating. I mean, obviously, one thing we're seeing, this kind of step down in growth that they're projecting. I mean, the stock's still at 60 times next year's earnings, right? It's always been a very expensive growth, priced for hyper growth. So it could be a very realistic, doable, positive outlook, and yet the stock just couldn't absorb it, at least at this point.
Because it's so highly valued.
Yeah,
it's been such a battleground, controversial stock.
For years.
There was a lot of short sellers in it, and a lot of the analysts say that's why the stock is up so much this year. They've gotten squeezed as Under Armour has posted better results on the operating side of the business.
Well, it'd be great to hear what he has to say tomorrow morning.